All right, so let's do some review. And I just took one or two slides from the last 3 weeks that I want to use, and we're going to build a couple of trades here. So when we started this journey 4 weeks ago, we talked about bending probabilities, about finding just those option strategies, those simple option strategies that allow us to bend our probabilities from 50-50, not in the wrong direction by buying options, but in the right direction by selling them. Now, I'm not here to say that buying options is bad, because I buy options all the time. I just don't buy options because of any statistical moves. Because if you're buying options for statistical probability, you're going to be on the wrong side of that trade all the time. I want to be selling option premium in a statistical sense, right? If I'm using seasonality and I find a seasonality trade that looks like it's going to be a seasonal bull that has some momentum behind it, absolutely, I'm going out and buying calls, or buying call spreads where I have a high profit trade. These are high probability trades. So the first one we talked about was the short put. And I talked about how to find those winners on the short puts. So we were looking at things. First thing we talked about was creating our price chart, and like making our price chart look like this, where we're creating this I call it the VLC. So I want to go back through and I want to walk through what I think are the most important takeaways of each week. Right. So I want to look at VLC. And to do that, we're going to log back in, and I'm going to log into the Hub website. This is going to be the first thing I want to do, is bring up a chart. And I'm going to bring up a chart on, again, it happens to be the chart that has the most popular right now amongst everybody, and that's oil and USO. So let me bring up a USO chart, and here it is right here. Let me pop it in with everything else. And this is, when I log in, this is exactly what happens. Is I bring up the chart, it's going to bring it up the way I left that chart. And so I left the USO chart looking at, again, where that target was back there in July. And I've got that run up you see here. I'm going to squeeze this in. So what I'm doing is I'm just clicking and dragging down. I'm looking at this overall chart. I'm looking at, again, my time frame, and I'm looking at what's going on with price. But boy, everything is kicking in for shorter term opportunities here for USO. So let's take a look at those for a moment. Now, down here, I've got this rewind, or really it's a chart reset. If I click on that, it resets that chart back for me. Clicking on the plus will bring this thing out and widen it, which is what I'm doing. The VLC, or volatility cones, we have added as a saved favorite. And if we click on volatility cones, it's going to throw those out there for us. And so again, if it looks like this, just a simple reset will change everything back to what we're looking at. Now, volatility cones, and these volatility cones are based on statistical probability, which is what you see here. And I turned off by the way, I just turned off the Fibonacci charts. But what you're seeing here is you're seeing this cone that goes, going projection in time. That width of that cone is based on what's been happening with the range of this. I mean, when you take an instrument that's an $80 instrument, you go from 80 to 120, that's going to make this cone blow up something big. Now, to change the cone settings, if I want to look at shorter term opportunities, I can change these cone settings by right clicking on the cone and bringing up the volatility cone settings. And then I can project my bars out. Right now I have it 50 bars out when I'm looking at USO, but I can change that and make it 20, which would be a month, or 40, which would be 2 months. You can bring those periods back and forth by how you want to look at that. All right. So that's the first thing. The second thing I like to add on the chart, and really is the first thing for everything I'm doing, is IV, implied volatility. And implied volatility, it takes a couple seconds for that to come in, but you can see what's happened. You can see that implied volatility in the oil market had gone up as high as 1.3, and that was just at the end of last week. And since then, it's come back down below 1. So even though oil is getting close to that high again, you're seeing a blow off in implied volatility. Still, when you see where it's been, when it was down here in the 30s and 40s, and all of a sudden we're at levels that I think are historic highs for oil, still even at 100 or 1.00, compared to where it's been, it's still more than double. It's double to triple where it was just a couple of months ago. So those options are still going to be expensive, right? So that's how I build that chart, okay? And then looking at, once again, if you're looking at the cones, the inside cone is a 68% statistical probability that the stock in question is going to stick in between those cones, or you have a 95% chance that we're going to likely stick in between these cones on the outer cone. My buy zone is going to be below the stock price. It's going to be somewhere in between these cones. That's where it ends up being. Sometimes it's closer to the first cone. Sometimes it's closer to the second. I had someone ask me a question, said, well, Tom, if it's over here at the, just outside the 68% zone, why is it showing a 90 or 92% probability of profit? Well, because again, this is based on strike price, or this does not include the option. This just shows you the stock price of where it's likely to be. So, for instance, if I'm looking at this, and this is an instrument that here's $30 and here's 40, and this might be 37. And if I'm looking at 35, you might immediately say, no, that can't be 90%. But when you factor in the option premium that you're going to receive, or you would receive, that's where it does the calculations using implied volatility, and then taking that calculation and moving forward and giving you that 90% trade. So I use this as a reference when I'm looking at the chart. But the option premium minus the strike price is what's going to come up with that probability, that future probability. All right. So everything you see on here is you can easily duplicate it on a chart. The sell put scan, again, and I'm not going to go through and read this, but this is the sell put scan is where I start my day when I'm looking at charts or looking at cash flow opportunities. So in order to get there, from anywhere, I can just click on the scanners button. And as you can see, more and more scanners are popping in place here for all of our partners. But I'm going to look at the sell put scan because that's what we're here to do in this session. And we've been doing now. So as I click on that sell put scan, it's going to open up the scanner tool for sell puts. Immediately, what it does is it's taking the latest data that we have, and it's applying it to all optionable stocks. As the reason I know this is because there are no stock lists, and it's searching them all. Okay, and that's where you're getting the actual numeric numbers that are coming up on the screen. I want you to pay attention to what we see on here: USO, 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 6, 7, 8. I mean, we have 8 USO trades before we get to something outside of USO. They're not the same trade. If you take a look, you're going to see these all have May expirations, but the break evens are different because 105, 104, 103, 101, 100, 97, 95, 94. So if I were to take a look at the May 95, okay, because that's quite a bit out of the money. It shows me May 95, what I'm can potentially receive. All right. And more importantly, I've got, things at the other end, like the probability of profit, which is 95%. I'm still above 2 on our calculation, where we're taking probability profit, and we're taking stock close, and we're taking the credit, and we're creating a way of re-scanning these or resorting them by, something that's more proprietary to us. What we're able to do is find out that this trade is definitely an interesting trade to look at. Now, if I want to look at further information on that 95, I'm just going to click on it. And when I do, up comes the chart, up comes the implied volatility. And also what's coming in is the option trade and the short put, the 95 short put. So this will come into place. The risk graph will come into place. There it is. And everything is there for me to take a further look at. So as I see here, I can move this. And again, I'm just hitting that reverse arrow that reset arrow that resets everything. Now, this goes out to July, my cone, but I can take that cone and I can bring that into May simply by, if I look at how many days to expiration we have, which is 58. All right, not 58 days to expiration. It does include weekends. So weekends and holidays. So we're really looking at a cone that we want to have that's about 40 days. So I can go into my volatility settings and I can change my projection bars for 50 down to 40. And so by doing that, I'm going to put a 4 in here and I'm going to, there we go. So now I have 40 days. Let's just double check that. And that brings us out to, well, that does bring us out to middle of May. And so what it's telling me when I'm looking at this is that my buy zone is going to be pretty close to, we get the 95s, but the 95s are coming out to be a price of $4.83. And again, we're going to be sitting right below the cone of 90, but it's still telling us that based on the option premium, based on the expiration, that we have a trade that has a high probability of profit or high probability of break even or better. Right? So that's building the core strategy. Okay. So Brian has a good question. And this is going to be the answer for everything that's huge. Okay. So I'm putting the question up on the screen for everybody to see. On the USA trade, would the pop take into account the resolution of the Iran war? It's taking in, remember, it takes into account everything. That pullback in implied volatility may be that. It may be everybody exhaling a bit, but it still didn't change the price. But every piece of data that is out there in the market that is known, all right, not insider information, but is known, is built into the price that we're looking at, the actual price of those options. Okay. All right. So, so when I move forward and I look at those, this is the exact thing I do, is that I'll take a look at, the overall market. What I like to do is I like to find an entry when I see, what's going on today, where I see a lot of red on the screen, because red on the screen means the VIX is higher, and the VIX is higher, and it's telling me that overall volatility is ticked up today. So then that is, I don't like coming in on a Monday, because I like to sell premium almost on a weekly basis, and so if I get in on a Monday and the market's up 400 points, I know volatility is more than likely down, so I will pass off on that. And what happened was we had a Monday and a Tuesday this week where we had the markets that were consolidating. Look what happens today. Boom, we drop and it's not like huge drops. We're down. We're down anywhere from just under 1% in the Dow to 0.5% in the S&P. But it's enough to let me know that what I was looking at yesterday was looking at yesterday's closing data, that the volatility is going to be up a little bit today. So that, to me, that's still in play. So I'll start with this, then I'll go to the scanner. And when I look at the scanner, I'll pop in and look at the sell put scan. And when I looked at the sell put scan today, and Jay was doing the exact same thing, we were looking for, so we're already in USO. So I'm out of USO, and then I start looking at, wow, look at everything else. I've got a SOXL trade going on right now. But then I see a firm holdings, and I see a firm here at $47.56. So I'm going to click on a firm. That's where I want to go. So I'm looking at firm, and I come out here and I see that this is also a May expiration. And so just to start, I've got a firm here. Short put, bring in $144, but it's also not a $400 stock. This is a 35 put with 2 months to expiration. So again, I'm gonna come out here. I'm gonna look at my my expiration dates, and this thing takes me out to the end of May. So I'm gonna want to take some time off this volatility cone setting. My volatility cone setting is at once again is at 40 or at 50. So I'm going to bring that down to 40. I'm going to click OK. Now I'm going to bring up the risk curve again. So there's my risk curve. right? I mean, we're kind of, you get below 35, we're into uncharted territory for this one. In fact, I'm going to turn the risk curve off for a minute, and I want to go back in time. I want to see, what was this stock at 35? Okay, you got to go back to April of last year. It's got some really good support down around 40. But then below that, you had those 2 days where we dropped below 40 and then we're right back above 40. So this is looks like an interesting area for a firm, right? We're also in between the cones that gives us the buy zone. I'm going to go ahead and set this whole thing up. We're going to create a trade, our first trade today, using a firm. So set this up, bring this down a bit so I can see the rest of the price chart. I want to open the price chart up a little bit more too. There we go. Jay, I hear you in the background there.
I didn't know if you wanted me to start things off, but you're on a roll, man. Just keep it running.
Okay. I mean, you're looking at a firm just like I am.
Mm-hmm.
So now what I'm going to do is I'm going to take a look at a firm and just like this, I'm going to get I have all these other sell puts, the other sell put stuff on the right hand side. I'm going to make that disappear because I want the real estate. All right. I want the real estate for more chart and risk graph and not so much a firm. And I'm going to take the real estate on this side too. So now I've got as much as I can when I'm looking at this. So let's kind of do a little review as I'm looking at this chart. A firm has, what's it got going for it right now? It's got AFRM, high probability, and it's also got good support at the $40 level. So that's the first thing I'm looking at right there. Let me set this up. I'm writing all this down as I'm talking to everybody so we can get everything in line when I actually look to see if this is actual trade that's worth placing. All right, so that's on the stock side. Okay, on the put side, when I look at the put side, the question I ask myself is, are we, is the put strike I'm selling below support? The answer is yes. All right. So the May 35 puts are below long-term support. So that's a good addition to what we're already looking at. So there's the trade setup. So now what I'm going to do is I'm going to AFRM puts, put entry. All right. So I got that part done. So now what I want to do is I want to look at Robinhood. I want to look at real-time quotes. So here's a firm, and a firm has been, this morning it was up almost 4%. Looks like it's back down into the $47 area, which is, this is perfect. I'm going to go ahead and look at the options, and I'm going to look at the May 35s. So I want to sell puts that expire in May 15th. All right, here's my put options expire May 15th. Let's scroll down. There's my 35s. Went too far. $1.62. So there, we're getting a lot more than $1.44 right now. The bid on those options is $137, and the offer is $186. You know what? I like this at $1.50 or better. So that's what I like. So what I'm going to look at here is I'm going to look at these at the 150 level or better. So at this point, what I want to do is I want to create that trade. So I'm going to create the trade AFRM, and then I'll place it. So what's my strategy? My strategy is the core trade, the short put, right? What's my expiration date? Once again, it's May 15th. And you know what? I'll set it up for all of you right here. So the strike price is 35. All right, sell to open. the credit I'm looking for is $1.50. Okay. And once again, firm is good support levels at 40 and high implied volatility coming into this week. Now, they more likely have an earnings. There's a reason why they're coming in, but this is also a best in breed stock, right? Which means they are one of the few that this whole buy now, pay later thing has really done them well. But most recently, they're seeing some pullbacks. Maybe there are not as many people doing the buy now, pay later, and so it's affecting them on the short term. The option traders think that staying above 35 is more likely what's going to happen. And that's the essence of our core strategy. So I'm going to put in here, if filled on this alert, hold to expiration. All right. So I'm going to preview my trade. Make sure that everything comes that we're looking at May 15th, sell to open. $1.50 on the 13 on that 35 put. That looks good. Let me throw in my chart that I've put together. There it is, and off and away we go. Now that's going out to you right now. So what I want to do is I want to look at the Robinhood again, and I'm gonna watch this so you can see the last trade to see if this thing is going to hit $1.50 or better. And there's 7 on the volume right now. So that's something that I'll follow along and look at. So what I'm going to also do is I'm going to open up. So you can think I can open up two of these at the same time, because I want to keep this for just a little to help me out as far as following along AFRM. All right. So that's the Affirm trade that we're looking at here as of right now. Let me plop this in place here. Let's look at, let's continue on here. So we've taken a look at our trade, with the sell put scan. If I have too many, I'll come in here and I'll reduce the filters and put a stock list in. We've done that before. I'm actually going to come back to this because I want to get to the actual the trade itself. We discussed the secret sauce, which is the probability profit times the credit divided by the close. But I look for low slippage. I look for high IV. I look for probability. Low slippage is going to be below 10%. High IV is just going to be a number above. Well, these are going to be numbers that are going to be above their quote, their range. And then that's what's going to show up on this scan. Probability is going to be greater than 90. All of that together is where we find our short put trades. We created our short put case study in Affirm. What I want to do now is I want to do the synthetic, which is the first one that we do, is the out of the money put spread. So the out of the money put spread is very simple. What we're doing is we're going to take the same trade that we have with the short put, because we know that short put already qualifies for everything. I just want to buy something lower with the same expiration date to force the trade to have a lower cost, lower margin. It's going to have lower reward too, but you'll have that protection in the rare event that things drop even more than they are right now. So let's go ahead and get into that. So it's a high probability trade. We know that it mimics the short put trade, but without the cost or risk. And everything I just mentioned, delta risk, slippage risk, time risk, even reward potential are lower, but that's the trade-off. So putting together the out of the money put spread, let's do that right now with Affirm. So I've got Affirm here. Let's check in on Affirm. 162. There's your trade. All right, 162 on that that Affirm trade. Now I'm going to reset up this again, but I'm going to look at it a little differently. We're going to look at it in terms of placing the put spread instead of the put itself. right, so the original trade is what we see here, and the last trading was around 162. So that's great. So what I want to do now is I want to look at the spread. So we're going to build the spread right off of not this page, but I've got this one set up ready to go. We're going to go ahead and trade the Affirm options once again. And give me just 1 second. I got somebody. Let's see. Who do I got here? I apologize, guys. It's live, and I got all kinds of people just all over the place. So, okay, all good. All right. So, once again, I'm gonna sell this this spread. To do that, I need to use the builder. Now, again, you can translate this in any brokerage platform or whatever brokerage platform you're using. But I'm going to create the out of the money call spread. I'm sorry, put credit spread. There we go. Okay, so up here, so this is a $35 put we sold. More than likely, I'm going to look at the $5 spread. I could look at a $4 or $3 spread, but if you're using round numbers like 35.30, it's going to give you lower slippage than using a 35.31 or a 30. I like to try to keep things as close to rounded off as possible. So let's come on down. Let's take a look at the 35.30. There's the 35.30. Now that's only going for 21 cents. Is that what? Oh, wait. I'm not done yet. Let's go look at the actual trade that was questioned the May 15th. That didn't look good at all. That was a terrible spread. So yeah, so this is better. So this is 80 cents. And that's probably 75 cents is what I would look to do this one for, but nothing less than that. So let's take a look at this one. And what you're seeing is here's the 35 puts at 162. And then here's the 82 for the 30 puts. So there's your 80 cents. But again, you're talking about, slippages, 152 by 171. That's actually not bad. All right. That's the slippage we're seeing right now on this trade. And then you see on the 30 put, it's 68 by 90. So there's 22 cents on the 30 put in terms of bid ask. And then there's looks like 15 cents, 17 cents. Yeah, they're pretty close to the same. So, you got to give yourself a little bit of room there when you look at the actual put spread itself. Right. So it's showing 90 to 91 cents. I think 75 is probably going to be, going to incorporate just enough on these. So let's take a look at building that and putting that together. So I'm going to do that here right now with everybody. What I want to do is I want to go back and I want to add it. I want to first add it into Hub. So in Hub, here's Affirm. Where's my there? Here, this is my Affirm trade, which was the original put sell. What I can do is I can come down here and I can find those 30 puts, and I see them. I see them right there. I'm gonna blow in and I'm gonna come back out. So in this case, you can see this is the one that we're short. I can come over here and I can move over to the ask and I can hit that 74. So I'm going to do that right now. And what that's going to do is that's going to build the actual spread itself. So let me bring that spread in place so you can see it. There it is. There's your put spread. There's your limited risk and there's your limited reward. And it's showing you can do this for 86. So again, that was the last prices that were brought in at the time. I think, and that 86 is right down the middle. So it makes sense that this one looks like more of a trade that has to be done for that 75 cent area. So I'm going to leave this just like this. And let me take a quick snapshot. So I'm going to snap this as well. And then again, nothing has changed. You got Affirm has good, it still has that nothing's changed on the chart itself. Still has the high probability and good support at 40. But on the right hand side, what do we have that's different than the short put? Well, the May 35 puts are long-term support, but if I'm looking at this as a spread, then we see the May 35-30 spread, right? Is below long-term support. Okay, so that is our, put that in, AFRM put spread. All right, let me build this one out. So from here, I'm gonna pop back in again, and I'm gonna build this trade up real quick. So we've got the strategy is now a put credit spread. Okay. We're going to look at put credit spread on AFRM. Now I have my buy and my sell. Again, May expiration. What am I selling? The 35s. What am I buying? The 30s. What am I doing that for? It says 86 cents. I'm going to want to bring that down to 75. And then, you know, same reasoning again. You know, you've got AFRM, high probability spread, good support levels at 40. Filled, hold to expiration. All right, now I'm going to add in, after I've done that, preview. I'm going to add in my put credit spread graphics. There we go. And this one is all set up, looks good. May 35.30, credit 75, send. Okay, so now you are now getting this one. Will be added to, you'll be seeing that one here momentarily as well. So I got my put credit spread over here. It's still sitting, hanging out at 82 mid price. And I imagine it's got to be, you know, in this area, this 82 to 90 something, if the 75 has a chance of getting filled.
And it hit the site already. Tom, Brian's asking what mark means in Robinhood, if you can comment on that. Even though we're not registered investment advisors and all that.
Okay. That's just, all that is, the mid price is the difference between the bid and the ask. All right.
Thank you, sir.
So let's see. So back to our scanner. So what we've done is we've taken the Affirm chart that you see there, and we've added probability. We've created our put scan, which was the May 35s. We've created our put 35.30 put spread, and that one is that was mid priced at 86. But we're seeing that now. You know, we're seeing with the slippage that 75 is that might even be tough to fill, but we'll see. We'll check in with that one a little bit later, and we'll look at those prices one more time. So that is puts and put spreads. All right, we've done our put spread case study. And so before I get to open positions, these are open positions we've done in the Cash Flow Mastery course. I want to hold here for a second. I want to go back to the scanner one more time and just kind of show you when we go into scan, we go into the sell put scan. And I mentioned this on week 2 and week 3. There's a lot of different ways you can bring those scans down from the 100 and some odd trades that you have. So if I look here and I just keep pushing this south, there's 180 trades I got that are popping up, right? To get that number down, there's a number of different things we can do. We can go to stock lists. You know, if I go to the S&P 100 list, it gives me a lot less than 180. I mean, I still see 173 on here, but notice it goes from 173 to 169, 167. It took those 180 stocks that we had and it ranked them. It still gave it the original ranking as on all optional stocks. But notice Amazon became the first trade in the S&P 100 top 100 stocks, Citigroup, JP Morgan. That's one way to do it, right? You could change stock lists. You could also put in, well, what's my calendar days to expiration? You've got things like, my break even to close, IV, probability of profit. There's a number of different ways you can change this. And what I'm going to do, and I didn't mention this in the last couple of weeks, but when we're done with today, I'm going to have the entire slide deck that I've been working with. I'm going to put that on PDF, and that will be attached today. That'll go out to you today in the commentary section, along with the link to watch the recording. So you'll have that entire slide deck for weeks 1 through 4. Sorry I didn't mention that earlier, but yeah, and the reason I'm doing that is because we have I have slides in here. Let me back up a second here, and I'll show you what I'm talking about. The areas which talk about these different filtering pieces that you want to go in and look at. So let's talk about open positions. All right, so these are the open positions coming into today and where they were. I take a look at these, and right off the bat, what I see is this is interesting. I see something I'm not typically used to seeing. So I got a USO trade where we've got a 30% profit on the put, but then I got a 10% loss on the put spread. How can that be? Look at Rocket, 6.89%. And that's because we went from a 9% down to a -18, and now it's coming back, that's fine. I understand that one. But then, I look at SoFi, same thing. It's kind of what's going on with the overall market. Our short put trades are being affected by those. But then I see SMCI up here, same situation. I got a 23 put, which was 92 cents, what was that, a week ago? Now it's a 72, going in the right direction. But the put spread went from 55 to 98. How can that be? This is the answer. The answer is because of all of the nervousness going on because of what's happening in Iran. It's causing options to have wide slippage between the bid and the offer. So when you see the short put is doing well, but the spread looks completely opposite, it's fine. It's that short put and that long put, they're put together to do that trade. They're both expanding in volatility and slippage. And so it's going to show you a number that, may not be correct. So let's take a look at each of these real quick as we're kind of moving along. And that would be, something that you could look at with if it's, Robinhood, or if it's, let me bring over SMCI. So if I look at SMCI, and this is, how I'll look at this is that SMCI again, this is the cards we're dealt with right now until we get the skirmish in Iran. It's kind of gets quashed a bit. But, up a 1.5% in the morning. Now it's down 2.25 this afternoon. But if I go and I look at the actual option trade itself, and I'll, pop over and say, all right, what were my option trades once again? I had the 23 put and the 1823 put. So let's look at, and was that May? Yeah, May. May is the expiration month that seems to be coming up a lot on our scans right now. So the 23 put, there it is. Nope, that's the calls. That gave me a scare for a second. 23, there they are. Up May. One more time. All right, I'm going to do this with the first one, but then with the others, we'll take a look at just the stock prices themselves. So 23 put is 78 cents. Okay, so I'll go back and I look. Where were we at? 72 cents. So it has come up a little bit. All right, but the put spread, again, what's the 18s going for? Let's take a look at those 18s. And more importantly, if you take a look at the slippage between the two, 66 by 89. This was not like this last week when we put this on. Look at the 18s. 15 by 50. 15 by 50. It's a 35-cent slippage. That's why. All right. So we're long that. And we're sitting on this trade all the way into May. So when you see this movement back and forth, it might be a little jittery. keep in mind, it's something that is causing SMCI to make these jittery moves, and it really goes all the way back to headline news. And as volatility drops in the overall market, you're going to see the out of the money put options kind of squeeze back in to where they once were. So when I look at these, you know, and I can look at, I'll look at stock, the stock positions itself, like SOFI, SoFi Technologies. All right, that's up on the day. Not as much as it was. Where was it? 10 a.m. is up almost 3.75% to pull back a little bit, but that's up on the day. That's going to be something that's going to be favorable to a short put trader. USO. I think USO, even being up, like USO's up 1.5%. I mean, it was down. You know, last night it was down almost 4%. It was up again this morning. That up and down is going to cause not only the short put to get more implied volatility, but the spread is going to be a little jittery, which is why you see the spread price at a loss and the put itself at a profit. It's not anything to be concerned about. I'm looking at this number right here, and I know that I'm $50 away from the 70 puts, and that's a long way away from where we are right now. Right, so that's USO, and the other one I want to look at was Rocket, RKT. Rocket Mortgage. Seems like these in Rocket's down 2% today, $14.52. But again, what am I looking at? The 12 put. So we're still a good ways away from that being even close to being hit. This is a situation where if the markets continue to be more nervous, I breathe a sigh of relief that I'm in an out of the money put on something that I like versus owning that stock. You know, so if you look back and you say, well, what's the month been for Rocket? Well, Rocket was an $18.42 trade when we first started. The week we started Cash Flow Mastery. So it's gone from 1842 down to where it is now. I'd say that's probably about a 20%. Yeah, it's a 20% drop in the past month. You see a 20% drop. And what's happened to the options? They're profitable still. So it just shows you what it feels like to be on the right side of the trade. And there's no guarantee that will continue to happen. I have a couple of these. Typically, a typical year, I'll have a couple of these go against me. I think I have 2 of them that are against me for this year. I didn't have any last year that went against me. But so far, coming into the first quarter this year, I've had 2 of them go against me. One being Trade Desk TTD, and one of them there was another one that went against me too. And I can't recall which one that is. But most of the time, we'll see these things come down and still end up being profitable, even though the stock trader saw a significant loss in his or her portfolio on a cash-to-cash basis. Okay, that brings me to covered call review. So what I want to do now is I'm going to have Jay just spend a few minutes looking at covered calls, and then I want to teach you a new strategy as we get to the back half of our program today. All right. So Jay.
Okay.
I'm looking for you. There you are.
Well, I got one slide to show, and then you
were
going to
need. Huh? That's all you need.
Okay. And then kick it back to you basically to build the cover call trade, if that's what you're going to do in Robinhood.
Sounds good. So I see you're looking at Hub right now. I see your Hub.
Yep.
Okay.
The Hub. Let me bring up that one slide, get that out of the way, because that's what we're discussing here, the cover calls. I guess I will blow this up. Let me see if I can blow this up from the current slide, because this is basically where we start a lot of the times. If you don't know the selling put strategy, if you don't know how to do that, you do now. A lot of times folks start with just buying the stock or taking a look at the stock that they own. And what you're looking to do is buy or sell. You're going to buy the stock and then sell the call option against it. You're just putting it up for sale. You're you paid to put a for sale sign up in your front yard. I call this sometimes, Tom, the Costco trade, because Costco, you have to pay them for a membership to even have the right to go into their store and spend more money.
Mm-hmm.
So you're charging people for the right to eventually pay you more money later.
Yeah.
So a lot of times the consideration is buy the security, write the call now. Second scenario is you buy the security, see what the money calendar data has to say, write the calls at a later date, anticipating that higher price move. So your premium now, if that stock goes higher, you sell the call option at that same strike later after it moves higher, you're going to get more on the sale of the premium. Your capital gain, if you've set it up properly, is still going to stay the same. Or you can wait for that security to rise, and then instead of writing that same strike price, raise the strike price that you're going to sell. You may get the same amount of premium that you did on that lower strike, but now you have the opportunity for a higher or larger capital gain. The bottom line is, I showed you this. We discussed this over the last couple of weeks. And then I said, then another consideration is selling the puts on the stock to maybe take ownership at a discounted price to the strike sold, and then start writing the covered calls. So let me get out of this. Let's go back to Hub. And Tom has gone over this, so this is even a review of the review session here. You have your chart page up. I always have a second Hub page up. I have two tabs Hub, because a lot of times I'm so focused on the money calendar data and doing that for the publications and such, that no matter what scan we're doing over here, and again, you just come over here, you click on the scanner icon. Okay, it's the third icon from the account icon on the far right. Go 3 over, and there's your scanners. We're going to bring up the sell puts. What I like to do is see, okay, if I'm on 317, that's the latest data for the sell put scan. On my other tab, I'm going to put the 317 up here. I'm going to alphabetize the list. And if I see a stock opportunity over here, I also like to see if I also have a money calendar bullish pattern. A lot of times the sell puts without doing the covered call is based off an anticipated move higher based from the MC data anyways. But as you learn more scans, I like to see if there's like another scan, like a moving average crossovers or whatever I'm looking at, a calendar or a candlestick pattern, a candlestick reversal pattern. If I see a reversal pattern, a bullish reversal that's calling for it to move to the upside, if I also have that coinciding with a Hub bullish money calendar, Tom's Tools money calendar upward move, I like to see if the different indicators kind of confirm the same stock. So that's why I have that up there. And if I alphabetize this, which I did, I don't see AFRM. It's not a deal breaker. It just means the AFRM that we found doesn't also have the bullish money calendar pattern for it, but it meets the sell put scan. And as Tom showed you, we go ahead and go down to the probability of profit times put credit over stock. We're going to click on the is equal to, click on is greater, and then I'm going to click into the value field. Now, don't start typing in a number, because watch, if I hit like the number 2, it's going to start putting in a minus. So I'm going to backspace that out. When I click in the value, I just hit my up arrow, and I go to the greater than 2. And then I go over here and I hit apply. And that's where we took that 180 down to 14. And there's the affirm. Affirm, 91% probability of profit on the sale of that put. But I'm not looking to sell the put just yet. I have to confirm some things. So I go to the chart and I confirm. And this is just reviewing what Tom already showed you folks, all right? We're going to head, and I'm just rolling my scroll mouse. The little up and down on my scroll mouse, it zooms it in. And it brings up that option strike that Tom showed you. It's the selling to open the May 15th $35 put for $1.44. Just bring it on over. And there you go. So if we're going to look at the probability of profit, there's a 91% chance that this thing stays in these cones. The 35 is right here. If I can bring in my target tool and left click on that. Okay, I'm going to right click on the tool. I just clicked on it down below to give me the opportunity to set it. And then when I set it on the chart, I can go in and edit the settings and change it as I want. Okay. Going to remove the drawing. I'd like to maybe even put a horizontal line, and let's just say 35. So I'll get close to 35 with my horizontal line. I'll edit it, and I'll type in 35 and click OK. And now it's on my chart. So that's where I have to worry about getting assigned the put. If it stays above 35 in these cones, we don't have to worry about taking the stop. But if it breaks below that 35 between now and that May 15th expiration, there's a chance of getting assigned the stock. And that's okay. What's 35 minus 144? Okay, that's your basis, if you will. So you're taking $1.44 now. If you get assigned at 35, you're going to end up spending $33.56 for this stock. And now you own the stock at $33.56. It bounces higher from there. You can sell it. You can look to start doing the cover call strategy. Maybe come back later and check if a firm gets on a money calendar buy list later, a later date. See what that projection higher is. Calculate your upward target and write your cover calls later when it gets closer to that. Or just take the premium that you can get for it now, anticipating the stock goes above that 35 and you get called out and you go from there. So there's your review, Tom, on the cover call strategy. One contract, 100 shares. So here's a situation where you might have to come up with a $35 stock times 100 shares, whatever that cost is going to be. And the big thing that we showed on this, folks, is if I go back to the list, sell puts. Tom mentioned this. I'll reiterate it again here. $95 on USO. We're looking at stocks that are 1,000 on ASML, 117 on Palantir, 321 on Micron. If your account has the capacity to buy 100 shares or get assigned 100 shares at these prices, don't let us stand in your way from doing this. But that's the big reason why AFRM was looking at attractive today. It's because it was at a price level that seemed more amenable to a lot of folks' accounts. Absolutely. And that could be the simple filter that you use. You get what you have here, and then you just choose by way of price, what I can afford. You know, that's sometimes as simple as it gets for deciding which one to go with. And so, Tom, have you got an idea of how to show them picking up the 100 shares and doing that, or just? I got
a better idea than that. We'll show them how they can do this without the cover call or in addition to the cover call. That's something we call the poor man's cover call. All right.
So if you want me to stop sharing, or you want to take it back?
Show everyone what I'm talking about here. So poor man's cover call is very similar to, when you sell a put, what's the alternative? A put spread. If you're buying cover call, what's the alternative? The poor man's cover call. So let's talk about what the poor man's cover call is. What we're doing is, instead of the stock price, we're going to buy an in-the-money call option, right? And maybe a deep in-the-money call option. Then you sell the in-the-money to at-the-money strike, and becomes your high probability spread. So it mimics the cover call trade, but without the cost and the risk of the cover call. So we look at what's your risk? It's your delta risk, it's your slippage risk, and time risk on the buy side. So let's build one of those using a firm. And so to do that, let me pop over and bring up a firm one more time, AFRM. All right, so we know the stock price is trading around the $46 level right now, or $44.58. It's making a move to the downside now. So if we like this one and we want to, instead of buying cover call or selling a short put, you want to do a deep into my call spread, it would look like this. All right, so if I trade the Affirm options, I'm going to look at the builder once again. So I want to build this time. I want to build the call debit spread. Okay, the call debit spread. We'll go out and look at May once again, that same expiration date. And maybe I'm going to look at a 5-point difference between the bid and the offer. But this time what I'm going to do is I'm going to go deep in the money. I could go deep in the money on both sides. So if I were looking at the 30-35, all right, the 30-35 is if I bought the 30 call and I sold the 35 call, I've created a deep in the money spread. Let's open this up and take a little bit more of a look at it. So here's the 30 call. Now, what's interesting about this one is when I look at this, it has a delta of an 87. That's great. That's literally, I mean, if we round that up and let's call that at 90 for a moment, it's going to move 90% of the stock. Okay, so that's your deep in the money option. So you also have the 35 calls, and the 35 calls have a 78 delta. So the delta combined is about a 10, which tells me right off the bat, I've got a trade here that has a high probability of staying deep in the money, or staying in the money, not deep in the money, but staying in the money. And so what's this trade look like it's going to cost? Looks like right down the middle, it looks like 350. So again, now this is one I'm just showing you as a case study. I wouldn't put it on simply because the slippage on this thing is just way too high right now, because it's showing 90 cents by 610, and no one would do anything like that. But that 350 right in the middle is not bad. Even $4 might make sense, because if we were able to do the spread that we were looking at, the other side, the put spread for 75 cents. Well, what's 75 cents, minus 5? That's 3 1/4. It's 4 1/4. So if I could do this for $4 or less, it actually makes more sense than the out of the money put spread. All right. So maybe the wrong one to be looking at is down 5% now. But we could always take a look at something else instead. So I can go back to my scanners, right? And I could clear my scans and look at just those scans that are across everything. And let's look for something with some low slippage. Maybe we start in that area. Coming on down, and here's a $4. Here's a 298. Oh, that's USO. Of course it is. Let's keep looking. I want to find something that's not USO. Amazon. All right. So Amazon's going to be expensive, but this is a good example of one that you could do the poor man's cover call with. So it's telling me right off the bat to look at the 190 puts. So instead of that, we'll turn that into a poor man's cover call. AMZN. Okay, and that's $211. So if I wanted to turn that into the poor man's cover call, we're going to click on Trade the Amazon Options. I'm going to build that call debit spread. Maybe look at a $10 strike width. And I'm going to look at the month of May. Let me just double check one more time on here. Yeah, the May options. Okay, and so if I come down and I look at the 190s, the 190-200s, the 190-200s are trading at $7.10. Let's look at some details on this. So the 190 calls, they have a 76 delta, right? When I look at this, 75 has got to be the minimum on the buy side. It just gives me that higher probability. So that's the 190s. The 200s, well, they're going to be a little less. They're going to be 67. So you still have something that has a 9 between the deltas. You're paying what, $7? It's showing $7.15 now, $7.18 for spread. So Amazon must be coming back up a little bit. Yeah. So I know that $6.95 by $7.45. That's much better than what we were seeing with the firm. But if you were to get for instance, throw $7 in here, which is a low likelihood, but if you were to get that, your cost and risk are 7, your reward is 3, and your probability is quite high because you're in the money on both the buy side and the sell side. All right. So that's a better example due to all the slippage that we're seeing right now going on in the marketplace. All right. So that's the poor man's covered call. A little bit more on that is, we looked at some opportunities to look at, deep into money call spreads, and Amazon seemed to have better slippage opportunities than Affirm being very, very high slippage at the moment. So adjustments. Well, what do you do with a poor man's covered call? Basis on the stock. As the stock goes up, the short call goes into money. You could consider rolling up the strike. Okay, if you want to that trade's going in your direction, and you want to try to eke out a little bit more, you could just keep rolling up strike. That means buy back the short put and sell something higher up, and hold the long calls, and hold the long calls as if they were like your stock. All right, we go sideways. The call could become worthless, or it could get assigned. Now that's always when you have something that's in the money. These adjustments are not the rule of thumb. The rule of thumb is that the long side could take away the short side. But there's another thing you could do with a cover call, because cover calls, remember, cover calls are what? They're not vertical spreads. A cover call is something where you're constantly hanging on to or rotating the short side of that trade. So I want to show you another way to do this. Okay, another way to do this would be to look at it as a diagonal spread. So let me bring up Amazon one more time. Here's Amazon, and this is this I have as the short put as the example. But what I'm going to do is I'm going to use the 190s, and I need to get rid of. Let's see. I want to keep my option strategy. I could get rid of the risk curve for now because I'm not really using it. Let's bring the options up one more time. Here we go. This is what I want to do. And let's get rid of this so we got some real estate over here on the Amazon side. All right, so I'm looking for the 190s. I'm going to need to bring my strikes out. Let's just look at everything that they have. And I want to be looking at the May options. So bring up the May 15s, and I'm going to blow these up so you can see them. I'm going to try to keep this, blowing this up and down as best I can. So here are the 105s all the way up to there's the 190s and there's the 200s. That's what I want to see. 190s and 200s for May look like this. All right, here's your 190s. They're 3065 by 3105, and then here's the 200s, 2305 by 2350. Let's put those two together and see what that looks like. So remember, I'm clicking on the ask to be the buyer. I'm clicking on the bid to be the seller. So here's my 200s. And now I've created that in the money spread, but that's not what I want to do. What I want to do is I want to look at selling the 200s in a different month. Okay, so what if I were to sell the 200s in April? Then let's back up. Let me bring this back down. Let's look at the April 17th expiration. And let's look at the 200 calls there. So here's my 200 calls. They're 1855. I'm going to click on that as a sell. Now, what I have is a diagonal spread. If you look over here to the right, what am I doing? I'm buying the 190s for May, and I'm selling the 200s for April. Maybe but what if May was not? What if May was not enough? Maybe I need to go out and look at June. Right, so if I put the June out here, now I've got 60 days. I got 92 days to expiration on the buy side. I got 30 days on the sell side. It's going to be a bit of a lopsided trade because you're paying $33.17 for those June expiration, and you're paying $33 for 92 days of expiration on the 190 calls. You're selling for 1873, but that's only 30 days on something that's closer to the money, right? So that's a way of putting together this trade as well. What's it going to look like on a risk curve? It's going to look a little weird. See? It's almost going to look like a butterfly. And the reason why it looks like this is because it's not a vertical spread. It's diagonal. It's more time-based on this trade. So as Amazon, if you noticed, as Amazon sits here at 213, if it just chips away, it's going to make money. But you know where the sweet spot is? The sweet spot's at 200 because you soak up that $18 and change of premium. But then what are you doing? You're in the money options that you bought. They're not dropping as fast as the options that you sold. So this is slightly bearish. How will we make this neutral? You get it closer to where the option is now or where the stock price is now. How do you make it bullish? You sell above the strike. So let's do one more. And to do one more, I'm going to get rid of the options. We're going to start again. Here's Amazon. Now this might require, when you're buying a call, if you're doing a cover call, Jay doesn't get the stock price cheaper. So let's look at the at the monies on the buy side and the out of the monies on the sell side to force it to be a trade that makes money on the upside, but still has that time decay effect. So to do that, we'll look at Amazon one more time. And I'm going to go and look at I'm going to collapse all the months. I'm going to go out and I'm going to look at June once again. There's the June 18s. Now this time I'm going to go into money, but I'm not going to go that far into money. With Amazon at 214, what if we just look at the 200 calls and let's buy those? 2605. There we go. Now I'm going to collapse this. So I know I'm already along the Junes. And see here, it shows I got to buy to open in there in the Junes. So now I want to go and look at the Aprils. Let me open up the April 17s. And I want to go above the option. I want to go a little bit out of the money. So the out of the monies would be maybe the 210s. There's the 210s. $5 by 520. I want to sell those. So I'm going to sell that 510. And then let's look at that risk graph. So that risk graph, well, the dates or the details look like this. Buy to open the 200 for June's. Sell to open the 210s for April. There's your 92-day trade options you're long. There's your 30-day options you're short. You're doing this for about, you take a look at this, it's chopping off 20% of the price right there. But remember, this is out of the money. You got potential move, upside move if you like that. If you wanted to go more to an out of the money option, or an at the money, you would be selling the 200s as well, and that creates the poor man's cover call. But what you're doing is you have a neutral outlook, and you're still bringing time premium in. All right, so that's the other thing we could do is if I change the strike price from 210, and all I got to do is click on the 210 and change it to 200, and that'll automatically bring in that. For some reason I have a put there. That didn't make sense at all. Oh, I grabbed the wrong one. My bad. All right, that's easily changeable too. They're actually easier to change a lot of this stuff over here on the details side. So there we go. Now this looks a lot better. So check this out. Long to 200 in June, $25.88. Short to 200 in April, you're bringing in $18.73. In my head, I was thinking, I got to look at the risk graph, but it didn't look correct. Now it looks correct. Now I could look at the 210s. And if I put the 210 in there, the 210s are bringing in what? They're bringing in 1120. I guess 20. You're almost bringing in half the value just to go for the 30-day option on the short side. So what's this look like on a risk graph? Let's bring it up. It's going to look like that butterfly again. And that's exactly what it looks like. It looks like that butterfly trade. I'm going to move this over like this, slide this over as well. Let's bring this into play a little bit more. There's your butterfly. Okay, so what does it show me? It shows me that range of break even or better, which is down here at 200. All right, you get your break even at 200 because we go below 200, and all of a sudden now what happens? That long option starts to get affected more than the short. The only other thing that could happen is you get above 240, the short option is going to start going parity with the long. So your sweet spot's right here in this square between 200 and 240. And it's in the next 30 days. It's not 90. It's 30 because your trade is based on the short side of the stock. So we could place this anywhere. All right. If you want the sweet spot to be at 240, what do you have to do? You have to sell the 240 calls. So you then go and look for the 240s. And watch this. See what happened? Now your profitable point is at 240. But this moves a lot more like a stock. It doesn't have the time. It doesn't have time decay like it used to. And you know why? Look what you're getting for the 240 calls. 67 cents. And again, if I take my 240s and I bring that down, if I want to make it neutral, 200, 200, this is what it's going to look like. Now we're right there. Sorry, that's not neutral. That's bearish. To make it more bullish, if I want to get right in the, where we are right now, I would ratchet up both the call strike, the long and the short to the level that the stock's at right now, which is about 215. All right, so I could do that again. It's just a matter of just clicking on these and changing strikes. 215 and 215. And now notice where the top hat is, the profitability, the biggest amount of profit is right here, where the stock is right now. Now you've got a sweet spot that's a little bit skinnier, but it's a neutral sweet spot. Also is a high probability trade. High probability meaning that, you're looking at statistical movement of Amazon. If we continue to get the statistical movement in April that we got in March, then this is going to be a really good looking theta trade here going forward. Jay, do you have any additional comments on the poor man's cover call when you compare it to what you were looking at?
Well, I was looking at what you're doing with Amazon. Amazon's on the list for money counter with a 10% move higher, average percent move.
Okay.
Over the next 40 days, if you wanted to do anything with a 10% move higher.
Well, then that would put us right back there around 235.
And you've done that already. Yeah. Okay.
And then, you would just ratchet this up where, you play with the strikes that you see here. And they give you that, it gives you the risk graph will kind of point you in the direction of where that sweet spot is. So
that was the only thing that I was looking at here is if you buy the stock now, wait for later. Well, the wait for later is now with a start date of today. Yesterday was 10%. Now it's an 8% move higher calculation. So that's right. All that is.
So, yeah. So, I mean, but, buying the stock at today's price, meaning buying the at the money call and then selling that 240 or 235.
Yeah.
And that's what this is going to look like. It's going to have, that's buying very little movement between today and expiration as far as break even. It really becomes a huge delta trade. And, it's the reason why is because you're only bringing in $1.17 on that. So, maybe we get a little bit more conservative. We say, all right, what about 215, 225 instead? So if I do that, now look what happens. Now you've got, that little bit of movement up gets you to the sweet spot faster. And then you've got all this area here that you're break even or better. But once again, you don't have any, your downside risk isn't terrible. Because
it's the premium of the call contract that you bought, right?
Moving sideways. I mean, eventually here's where your risk ends up being is, the difference between what you bought, what you sold.
Yeah.
And
doing a cover call on a call option contract versus a cover call on the stock. I mean, the stock alone at 100 shares is 21,000.
Mm-hmm.
Well, here your cost is basically what, 1,200 or 2,200 or something. So yeah.
Yep. That's right. So, summary, neutral, bullish, or very bullish outlook on the underlying. You can have either, depending on what you're looking at. And like Jay said, you could use other things to make that decision. Buy a long-term deep in the money call and sell the short-term, either at the money, the out of money calls are best. You want to make sure you got about 60 days between the buy and the sell. That way you're able to adjust it. So let's say that, you move forward 30 days. What you still have is a 60-day option, because your 30-day option, if we used the example of April and June, and come April expiration, you still have the June. You could rotate the April out and sell the May. And now you got a May, June. And you could even rotate out the May and sell a June, and then kind of morph that into a vertical spread. That's a possibility as well. So, there you go. All right. So moving forward, that and I talked a little bit about adjustments that you could, if the stock goes up, the short call goes in the money, you could roll that up. Right? Stock goes sideways, the call could get worthless. You could consider rolling out to the next month. Stock goes down, consider rolling the short option down. Right? When you've gotten 80% of that maximum premium that's been received. So that puts us at next steps. And so, guys, you now have all the tools that I use. All right. You see all the tools I use and all the steps I use to create these short put spreads. We added on some additional synthetics, talking about cover calls and poor man cover calls over the 4 weeks. But when it comes to next steps, I want to focus on going back to the basics. What do I do now? So what do I do now with short puts? Again, number one thing that I would do is I would see what fits your risk reward parameter. Meaning, for example, today we saw a lot of stuff on the scanners that were $100, $200, $300, $400 stocks. And so that might take into account what you're looking to do. So take that risk, take that all into account when you're looking at these opportunities. Right. That's the first thing. Next thing I do is, for example, a $20,000 cash secured account or a cash secured put can become a $10,000 or even $4,000 trade when you step to a margin or an unsecured account. So again, that all has to do with risk reward and how you feel, how comfortable you feel doing this particular trading strategy. All right. One per week. You've got it. So I have this one per week equals an average of 8 positions before rotating. What does that mean? Okay. Well, that means if you're using 60-day options and you're putting it on and you're not taking it off, you're leaving everything on, then if you did one per week, you could have 8 of these on at any one time before the ones you put on 60 days ago could come off the board. That's if you let them expire. Sometimes what I like to do is when I get down to that 90% and it's got a lot of timed expiration, I'll take it off, and it releases that obligation, that cash obligation that I can put towards something new. Okay. Now, another thing you could do, and we're going to talk about this in a moment, is short put credit spreads. Those out of the money credit spreads really does take a lot of this and make it easier for the smaller accounts. So, account ideas, so you can see $160,000 for a cash account, $80,000 for a margin account, $32,000 for unsecured, following these rules of that 8 positions, one per week. And I'm giving you a static number here. That will vary. But the way you can create this without any variations is with put spreads, right? So you got in the money calls or out of the money put spreads. And then when, if you're doing an in the money call versus an out of the money put spread, that would be, buying that deep in the money call spread or selling the deep out of the money put spread. They're probably going to be the same strikes. So because of that, you got lower cost and you got lower risk than a short put. You also got lower reward, but keep in mind, all of a sudden now you've opened up that possibility for a smaller account to be able to put on multiple trades, right? You could trade probability for a lower reward. I wouldn't go less than 80% when you look at the reward to risk ratios. But typically what I do is I use the sell put scanner. I take that 90% reward on the sell put. Then I'm looking to find something below that to buy. Maybe it's 5 points below. Maybe it's 10, right? But if you look at the reward to risk ratio on the spread, in every case I found, almost every case I found, the difference of what you're getting versus what you're risking far outweighs just the short put, right? You might wonder why. Why is that? Why can't I put a spread on and get a 20% reward to risk ratio when if I did the short put, maybe I'm getting 3 or 4% cash secured, maybe 2% cash secured. That's because at the end of the put, you still, that's something that can turn into stock and something you could continue to work with, okay? Because it is in essence a synthetic. It could become a synthetic long if it gets assigned. Where a put credit spread, because you have that extra layer of protection, it's also costing you, and that could be something where if it blows right through, like Trade Desk. All right, so Trade Desk had an interesting 24 hours. That thing went. Let me bring that up right now, and that's my loser for the year. Let's bring up TTD. Here's Trade Desk. So I want you to take a look at the 1 week on Trade Desk. So this was just yesterday, $28.40. So had the $30 puts and I had the 25-30 put spread. And as of yesterday afternoon, coming into 11 o'clock, so the trade ended up being not that far away from break even. And that was with a couple days going into expiration. But then they had the worst of all things that could happen, some sort of an accounting issue with clients. And that news broke in the afternoon. You can see what happened from 2 p.m. to 3 p.m. Stock goes from 28 to 25. All of a sudden, it goes from being positive to down 10%. And then they spilled it over again into today. And so this is one that just, it had a unfortunate right 2 days before expiration, 3 days before expiration, the unfortunate event that happened, which will happen to you. I guarantee it's going to happen. You have to realize that this can and will happen from time to time, where you have a company that everything was right, but it's come down and all of a sudden something comes out. And all of a sudden now price discovery begins, which is, okay, this is not a $30 stock, according to traders, because of the new information. What is it going to be now? And I looked at this, and typically what I'll do is I'll just take the stock and start selling covered calls against it. But because of the difference in price discovery and the fact that if you look at where it was year to date, where it was, trading at 40, and this is where we were putting this thing on at in the high 30s. And for it to come down as much as it did means that, we don't know where that price discovery goes from there. A year ago, $89. And so, the drop down here was a sales drop. And at the time, okay, good company, big sales drop, great opportunity. But then it just slowly got worse and worse. And now, we're thinking we're down here. There was a short squeeze that really looked like it was going to happen. Well, not going to happen now. And I'm not going to wait around and try to find it happen. I'm going to move out of this one, move into another one. But the silver lining on this is that the put spread, the 25-30 put spread, only had $5 of risk minus the premium that was collected. So, you're with your spread, that you've got the cost is risk. Jay and I say that all the time, and this is the case that really did happen. So, you come back and you look at, well, do I want to own this? And last week I'm thinking, yes, I want to own this. And this week with the new price discovery, I'm like, there's still a lot of things we don't know about Trade Desk that we thought we knew a week ago. So I'm moving out of this one. I'm going to move into the next opportunity. And so that's what I'm doing. All right. This happened to Tesla. Last time I remember something like this happening, it was Tesla, where Tesla went from $200 a share down to 120. Completely different company. And that final week of expiration, it shot right back up. It didn't go to 200, but it shot up into the from being an in the money option right to be back to out of the money. And even if it didn't, the Tesla news was more Elon Musk chattering when everyone wanted him to be quiet. There was no differences with the company at all. This is a company difference, which is why we are moving aside on this one and moving forward. So those will happen. But again, the silver lining was that, the spread capped the loss. So with the spread, you could, if you did, again, one per week, same thing. If you have 60-day trades going on, you could be pushing stuff out. These 60-day trades you put on at the beginning, starting this, come to maturity in 60 days, you would either have taken them off, but with credit spreads, more than likely you're hanging on to it all the way to expiration, because the slippage getting out in most cases doesn't make sense. So you're holding on, you're placing more trades. And if you did like a week, one of these a week, you got 8 of these on before the first one comes off or the first bulk comes off.